Stop scrolling because what just happened in silver wasn't a normal pullback. It was a trap door. One minute, people were celebrating new highs. The next minute, portfolios got sliced up. Group chats went silent, and the loudest I told you so voices suddenly stopped posting. And here's the part nobody wants to admit out loud. Most people didn't lose money because silver failed. They lost money because they didn't understand what they were actually holding. Today is Saturday, January 31st, and right now it's 11:59 p.m. I've watched markets for years and I still get surprised. Anybody who claims they saw every detail of this coming is either lying or rewriting history after the fact. Silver is a wild animal. It doesn't move like a polite asset. It lunges, it fakes, it whips, and when leverage is involved, it doesn't just move, it snaps. But here's the twist. The crash doesn't automatically mean the story is over. It also doesn't automatically mean we're headed to zero, and it definitely doesn't prove that silver is worthless. What it proves is something simpler and more important. Price is loud, value is quiet. Price screams, value just sits there and waits. And if you only listen to the screaming, you'll sell the insurance policy right before you need it. In this video, I'm going to do three things. First, I'm going to explain what likely triggered the speed of this drop and why it felt like the floor disappeared. You get long-term holders who want protection, people who like tangible assets, people who like privacy, people who like certainty, and you get short-term traders who want speed, people who use leverage, people who borrow confidence from a chart, people who think risk is something that happens to other people. Those two crowds can push price up together, but when something breaks, they don't react the same way. The long-term crowd hesitates, the leverage crowd gets forced, and forced selling is a different species. It doesn't ask permission, it doesn't care about fundamentals, it sells because it has to. Based on recent market updates, one of the big mechanical drivers behind this kind of sudden drop is the way futures exchanges respond when volatility spikes. When price goes haywire, margins get raised. That means if you're holding a leveraged position, you suddenly need more cash just to keep your seat at the table. A lot of traders don't have that cash sitting there. So what do? They liquidate fast. And when a lot of people rush for the same tiny door, the door doesn't get bigger. People just get trampled. And yes, this kind of thing has happened before. In past silver blow-offs, margin hikes and liquidity stress have acted like gasoline on an already burning fire. That doesn't mean the exchange is evil. It means the system is built to protect itself first. You're the one who has to protect you. And this week was a brutal reminder that the plumbing always matters. When volatility goes vertical, the people running the pipes tighten the rules. The easiest lever is margins, more collateral, less leverage, less risk for the system. If you're funded, you shrug. If you're stretched, you're forced to sell into the drop. That's why these crashes feel like the floor vanished. It's not that every buyer suddenly hated silver, it's that leverage ran out of oxygen. We've seen versions of this movie before when silver got crowded and the rulebook got stricter. The names and the dates change, but the mechanics rhyme. Here's the cliffhanger. Forced selling ends. It always ends. The only question is whether it ends with exhaustion or whether it flips into a rebound that punishes the late panic sellers twice. Now, here's the part that makes this worse. Silver doesn't trade like a giant market. It's smaller than people think. That's why it can move violently. Add in algorithmic trading, add in options dealers hedging, add in stop-loss clusters, and suddenly the chart turns into a waterfall. The first drop triggers stops, stops trigger more selling, and selling triggers more margin stress. It becomes a feedback loop, a machine feeding itself. So if you're sitting there thinking, how could it drop that hard? That's your answer. Not because silver's uses evaporated, not because the metal stopped being important, not because every buyer changed their mind in one afternoon. It's because positioning, leverage, and rules collided. Now get practical about physical versus paper, because this is where people accidentally choose the wrong tool. Physical has friction, premiums, storage, slower selling. Annoying, yes, but that friction can protect you from impulsive decisions. Paper exposure has speed and convenience, but you're living inside a structure where rules can change, collateral can change, and liquidity can disappear when it's least convenient. So, define your buckets. Core metal for long-term insurance, tactical metal for opportunities, and define your liquidity. If you don't keep cash reserves, the market will eventually force you to sell something at the worst moment. That's not fear-mongering. That's how life works. Also, don't waste energy hunting villains. Learn the predictable pain points, margin rules, leverage piles, stop-loss cascades, and narrative whiplash. Those are beatable if you respect them. But I'm not going to let you off the hook completely because there's a second reason people got hurt. The mental model was wrong. Most people treat silver like a scoreboard. Up means they're smart. Down means they're dumb. That's childish, but it's human. We all do it. I've done it. You watch a bull run. You start believing it's supposed to continue. Then a crash shows up and you feel personally attacked, like the market betrayed you. Silver didn't betray you. Your expectations betrayed you. Here's what I want you to lock in. There are 3 different silvers living inside the same word. There's trading silver, the paper price, the quote on a screen, the thing that can move 10% before lunch. There's monetary silver, the idea of silver as a store of value outside the banking system, a physical asset that doesn't need anyone's permission to exist. And there's industrial silver, the metal that gets consumed in the real economy, the stuff that ends up inside devices, grids, vehicles, and infrastructure and doesn't come back easily. When price crashes, trading silver gets punched in the face. Monetary silver barely notices. Industrial silver keeps doing its job. So the question is, which one were you buying? Because if you were buying trading silver while telling yourself you were buying monetary silver, this crash exposed the mismatch. You were psychologically unprepared. That's why it feels like the ground moved under you. Now I can already hear someone saying, okay, but did we top? Is it over? Let me give you the honest answer. I don't know. And anyone who says they know is selling you certainty like it's a product. Could we have already seen the peak for this cycle? Sure. Could we rip back up and make new highs anyway? Also sure. Could we chop sideways and torture everybody for months? Absolutely. Silver loves to make people regret decisions, but I can tell you what I'm watching. And this is where we get beyond vibes and into signals. Here's a concrete way to read the crash without getting hypnotized by the candle. Ask yourself what changed in the real-world balance sheet of silver. Because from the latest publicly available filings and industry surveys, the big picture going into this year looked like this. Industrial demand was still heavy, and in a lot of categories it was making new records while supply growth stayed slow. Mine output doesn't jump just because a chart goes vertical, and a large share of supply still rides on byproduct mining. That means the market can stay structurally tight even when price gets chaotic. At the same time, this is where the story gets spicy. High prices can create 2 opposite forces at once. On one side, you get more recycling and more scrap flows. People dust off old holdings. Manufacturers renegotiate. Some ounces come back to market. On the other side, you also get fear buying and strategic stockpiling. Industrial users don't want to be the factory that shuts down because they can't source a critical input, so they build buffers when they can. Those 2 forces can collide in weird ways. A paper crash can happen while an industrial buyer quietly locks in supply. A scary headline can print while a refinery backlog stays long, and that's why if you only watch the price, you miss the story underneath. Now add one more layer, the clean energy build-out. Solar manufacturing has been one of the loudest examples of how silver is both essential and contested. When silver surged, some producers started pushing lower loadings, and some started experimenting with alternative designs. That's real, but the reason they're doing that is also real. Silver is expensive because it's valuable. It does a job that's hard to replace perfectly. So when you hear demand destruction, don't translate it as silver demand disappears. Translate it as silver demand adapts. An adaptation can slow growth, but it can't erase the need for conductivity across a world that's electrifying everything. Here's the next cliffhanger. The market is going to spend the next stretch deciding whether this was a leverage flush inside a continuing bull cycle or whether this was the moment the cycle rolled over. That decision won't be made by influencers. It'll be made by flows, by positioning, and by real buyers showing up when the excitement is gone. And that's exactly why the weeks after a crash are so revealing. Anybody can be brave on the way up. The real signal is who buys when it's quiet. 1. What happens in the physical market after a paper crash? Do premiums collapse or do they stay stubborn? If physical tightness remains while paper price dives, that's not silver dying. That's a disconnect. 2. What happens to future spreads? When near-term supply feels scarce, you can see stress show up in the way the market prices time. You don't need to be a prop trader to understand that. All you need to know is this. When people want metal now, not later, it tells you something. 3. What happens to industrial demand narratives? Because here's the uncomfortable truth. High silver prices can actually cause demand destruction in some sectors. Manufacturers start searching for substitutes. Engineers start thrifting the metal, using less per unit, and in a few places they really can. That's a headwind no one wants to talk about when the chart is going straight up. According to recently published numbers, the solar industry alone has become a massive slice of industrial silver use. And when silver gets too expensive, solar manufacturers feel it immediately. They don't just complain, they redesign. That's bullish for innovation, but it can cap demand growth at the margin. And yet, here's the paradox. Even with substitution efforts, industrial demand has still been hitting records in recent years, while supply growth stays slow. That's not my opinion. That's the structural reality of digging metal out of the ground. Mines don't appear because a chart looks exciting. They take years, permits take years, financing takes years, and the easy ore bodies aren't getting easier. So, you have a market where demand is sticky, supply is sluggish, and price is explosive. That combination doesn't create a calm, steady line. It creates what we just lived through. Now let's talk about the emotional damage, because that's what really ruins people. When silver was screaming higher, a lot of folks started talking with absolute certainty. It's going to 150. It's going to 200. It's guaranteed. Let me be blunt. Anybody talking like that is either inexperienced or marketing something. Markets do not reward arrogance forever. They punish it on a schedule. You just saw the schedule. The better approach is probabilistic. You make a thesis. You size your risk. You prepare for being wrong. You don't marry a price target like it's your identity. So here's a question for you, and I want you to actually answer in the comments. When silver was running, did you make a plan for what you'd do if it dropped 30% in a day, or did you just assume it wouldn't? Because if you didn't plan, the market planned for you. Now let's address the bigger thing. Why silver matters even after a crash. Silver has been a monetary metal for thousands of years. That's not romance, that's history. It's been used because it's divisible, durable, recognizable, and hard to create out of thin air. And that last part, hard to create, is the entire point. Fiat money is easy to create, that's why it exists. It's convenient for governments and central banks. But convenience comes with a cost. Over long stretches of time, purchasing power leaks out. It doesn't disappear in one dramatic explosion. It leaks quietly, like a tire you keep ignoring until you're riding on the rim. That's why people like hard assets. Not because they're trying to get rich overnight, because they don't want to be forced into the same game everyone else is playing. And silver sits in a strange place. It's not just a safe haven like some people treat gold, it's also a working metal. It lives in both worlds. That's why it can outperform on the way up and terrify you on the way down. Now, there's a popular talking point that goes like this. The dollar is going to collapse any day now. I'm going to push back on that because it's not useful. The dollar can weaken without collapsing. It can lose purchasing power while still being heavily used. It can stay strong against other currencies while still getting weaker in your real life. Those things can all be true at the same time. So, if your whole thesis is collapse tomorrow, you're setting yourself up for disappointment. The more realistic thesis is the system incentivizes debasement over time, and hard assets are one way to defend yourself against that trend. And that's why even when price drops, the ounces don't magically become less real. This is where the mindset shift matters. Stop measuring your entire wealth in dollars first. Start thinking in units, in ounces, in time, in optionality. Because the whole point of owning something outside the system is that you're not forced to play by the system's mood swings. Now, I want to talk about something that's getting hyped right now. The idea that certain states are moving toward recognizing precious metals for payments. A big state has legislation on the books that treats qualifying gold and silver coins as legal tender for certain debts starting later this year. That's a headline that gets people excited, and I get it. But here's my skeptical take. Legal recognition is not the same as daily adoption. It's a step. It's not a switch. Most people aren't going to pay for groceries with coins next week. Businesses have accounting systems. Taxes are calculated in dollars. Payroll is in dollars. The rails of commerce are still built around fiat, so don't overhype it. It's meaningful culturally. It's meaningful politically. It's meaningful as a signal that trust is shifting. But the real game changer isn't a law. It's infrastructure, storage, payments, reporting rules, and whether people actually choose to use it. On the state legal tender story, keep it in the right box. It's a cultural signal that people are questioning what money is, but recognition isn't the same as everyday adoption. The bigger question is whether more people choose to store value in something that can't be created with a keystroke. And here's my skeptical angle. Silver's industrial importance is real, but demand isn't perfectly invincible. When price spikes, engineers thrift and substitute where they can. That's not bearish. It's reality. So don't base your conviction on headlines. Base it on behavior after the shock. Premiums, availability, industrial tone, and whether the panic was mostly paper or truly physical. That's me challenging a point you might have heard elsewhere. And I think it matters, because if you build your conviction on headlines instead of on fundamentals, you'll get tossed around. Now, let's get back to fundamentals because that's where your sanity lives. Silver is used in electronics, it's used in electrical contacts, it's used in medical applications, it's used in chemical processes, it's used in the energy transition. And yes, it's used in the very technologies that everybody's obsessed with right now, data centers, high-performance computing, and the hardware that keeps artificial intelligence from being just a buzzword. Even if the AI stock mania cools down, the physical build-out doesn't instantly vanish. Servers still get built, power systems still get upgraded, grids still get strained, and all of that is metal intensive. But here's another cliffhanger. That doesn't automatically mean price goes up tomorrow, because markets don't reward truth on your timeline. They reward liquidity on their timeline. That's why you need a strategy that survives both hype and punishment. So let's talk strategy. And I'm going to keep it simple. I believe in separating your silver into buckets. One bucket is your core, the metal you hold because you want an insurance policy. You don't trade this bucket based on adrenaline. You don't sell it because a chart is scary. You hold it because you want optionality in a world that keeps getting weirder. The second bucket is tactical. The metal you're willing to move around. Maybe you sell some into strength. Maybe you buy some into weakness. Maybe you swap between products. Maybe you use it to fund another asset. This bucket is flexible. If you only have one bucket, you get emotional because every decision feels like life or death. If you separate them, you get calmer. You get to think. Now, here's where I'm going to challenge the never sell crowd. There's a version of stacking that turns into ego. People treat it like a purity test. If you ever sell, you're weak. That's nonsense. Real life exists. Emergencies exist. Opportunities exist. And if you're so rigid that you can't respond, you don't have conviction, you have a cage. So I'm not going to shame anyone who took profits near the top. And I'm not going to shame anyone who had to sell because life hit them. What I will say is this: if you can build a core position you don't touch, you can let the rest of your decisions be practical instead of emotional. That's not glamorous. It's not a meme. It's not something you can brag about, but it works. Now, if you're sitting there thinking, okay, but what about the crash itself? Should I buy this dip? I'm not going to tell you what to do, but I will tell you what questions to ask first. Do you have cash reserves? Because if you're buying dips with money you might need for bills, you're gambling, not investing. Second, are you buying physical metal or are you buying a paper claim? Those are different risks. Physical has storage and premiums. Paper has counterparty and structure. Know what game you're playing. Third, what are you trying to accomplish? If you want fast profits, you're in a different world. If you want long-term protection, you can tolerate volatility differently. And fourth, can you emotionally handle another leg down? Because it can happen. Markets can overshoot to the downside the same way they overshoot to the upside. If you can't handle it, you'll buy high and sell low like clockwork. This is also where people underestimate time. A crash feels like forever, but markets can heal in surprising ways, or they can churn and bore you to death. The point is, you don't get to choose the path. You only get to choose your position and your patience. Now, I promised you I'd talk about what likely accelerated this drop, and we've touched margins, leverage, and stops. Let me add one more layer that people forget. Positioning in funds and products that track silver. When the narrative goes mainstream, big pools of money pile in through the easiest vehicles. When volatility spikes, those vehicles can see outflows fast. Dealers hedge, futures get sold, the selling pressure becomes concentrated. Again, it's mechanical. That's why you can see a day where the metal's real-world importance didn't change, but the price chart looks like the end of the world. Now here's the cliffhanger I want you to sit with. The same mechanics that can create a violent crash can also create a violent rebound. Forced selling can flip into forced buying. Shorts can get squeezed. Dealers can chase. If physical tightness stays real while paper players unwind, the setup can get interesting. But interesting doesn't mean easy. That's why the smartest move for most people is not Allen or all out, it's structured exposure. Let's talk about the psychological side one more time, because I want you to win long term. If you're successful, share your success story in the comments so others can stay motivated. That's not just a nice line, it matters. People watching this are either new or they're bruised or they're trying to learn. They need to see what responsible decision making looks like over time, not just hot takes on a red day. Now, I want to address something else. The idea that silver's value is just the price. That's a trap. Value is also what it can do for you. Can it diversify your risk? Can it give you optionality? Can it sit outside your bank? Can it survive policy changes? Can it survive a system where rules get rewritten when the pressure is high? And here's another fresh point that doesn't get talked about enough. Volatility itself is information. When an asset can swing this much, it's telling you it matters. Nobody panics over something irrelevant. Nobody gets margin calls on something nobody wants. The chaos is evidence that silver sits at a pressure point in the system. Now, that doesn't mean it's guaranteed to go up. It means it's contested. So, how do you navigate a contested asset? You stop seeking prophecy. You start building process. That means you decide your core allocation based on your personal risk tolerance, not based on a YouTuber's confidence level. It means you build liquidity, so you're never forced to sell at the worst time. It means you stop buying at emotional peaks just because it feels good, and it means you stop dumping at emotional lows just because it feels safe. If you do that, you become the person who benefits from volatility instead of the person who gets eaten by it. Now, I want to add some context that wasn't in the competitor script because it matters for the next phase. Recently published supply and demand snapshots show that industrial fabrication has been running hot while total supply growth remains modest. That's why even a price crash doesn't automatically fix the market. A crash can shake out speculative demand, but it doesn't instantly add new mines. It doesn't instantly increase refined output, and it doesn't instantly reduce the need for conductive metal in the build-out we're living through. At the same time, high prices have pushed industries to innovate. In solar, manufacturers have been pushing lower silver loadings per cell, and some are scaling alternatives. In electronics, engineers constantly optimize. That means demand growth isn't a straight line. It's a tug-of war. So what does that mean for you? It means your thesis should not be silver shortage equals straight up chart. Your thesis should be silver is structurally important, supply is constrained, demand is adaptive, and price will be volatile. That's realistic. That's survivable. Now, let's talk about the next few weeks because people are going to ask, what happens Monday? Here's what I'll be watching when markets reopen. Do we see continued liquidation or do we see stabilization? Do we see buyers step in or do we see another wave of fear? Do we see the media run victory laps about the end of metals or do we see silence? Because mainstream narratives are predictable. When metals rise, they ignore it until it's convenient to call it a bubble. When metals crash, they point and laugh as if the long-term issues disappeared. Don't let someone else's narrative become your strategy. Also, if you want tighter updates without me stretching things into a full video, that's why the premium WhatsApp channel link is in the description. And if you want the deeper dives, we offer members-only videos. Those are produced by a separate team with more research, and they're only for premium members because we can go longer, show more context, and answer the questions that don't fit in public videos. Now, I want to talk directly to the person who bought near the top and feels sick. Listen, you are not the first. You won't be the last. The market's job is to find the maximum pain point. It's what it does. The key is what you do next. If you overextended, fix it. If you used leverage, learn from it. If you let ego make decisions, humble it. If you didn't have a plan, write one. Because the only real failure is refusing to adapt. And if you're the person who's been stacking for years and you're watching the chaos with calm, I want you to remember something.